What are the tax implications of REITs' 90% rule? Imagine earning income from real estate investments without the hassle of managing properties or paying double taxes. That's what makes real estate investment trusts, or REITs, so appealing. But how does the tax system treat them? Let's break it down. REITs are special because they are considered pass-through entities. This means they don't pay federal income taxes on the profits they distribute to shareholders. Instead, they pass most of their income directly to investors, who then pay taxes on it. This setup helps avoid the double taxation that regular corporations face, where profits are taxed at the company level and again, at the shareholder level. Now, the key to this tax advantage is the 90% rule. REITs must distribute at least 90% of their taxable income to shareholders each year. These distributions include different types of income: ordinary income, capital gains, and return of capital. Return of capital is a special case because it is not taxed in the year received. Instead, it reduces the investor's cost basis in the REIT shares. When the shares are eventually sold, any remaining basis is taxed as a capital gain, which usually has a lower tax rate than ordinary income. For investors, this rule means consistent cash flow because REITs are required to pay out most of their earnings. Plus, the tax treatment of return of capital can help defer taxes, making REITs more tax efficient compared to some other investments. If a REIT distributes more than its basis in return of capital, the excess is taxed as a capital gain, which can be advantageous for tax planning. It's also important to understand that the distributions from REITs can be a mix of income types. Ordinary income is taxed at your regular income tax rate, while capital gains are taxed at lower rates. This mix can help investors manage their tax bills more effectively. In addition, the 90% rule influences how REITs plan their distributions and investments. They often focus on generating steady income streams to meet the distribution requirement, which appeals to income-focused investors. This rule also encourages REITs to distribute most of their earnings, keeping their tax status intact and providing investors with regular income. So, in simple terms, the 90% rule keeps REITs in good standing with the tax authorities, allowing them to avoid paying corporate taxes while passing most of their income to shareholders. For investors, this means receiving regular income with potential tax deferrals on certain parts of the distributions. Understanding this rule helps you see why REITs can be a smart choice for building a steady income stream while managing your tax obligations effectively.